Okay, let's continue on. But I need a marker, so hold on. Come on, people. Oh, there we go. Hopefully this one works. Okay, so we're going to talk about depreciation today. And as I had mentioned, depreciation for tax purposes is very different from depreciation for financial accounting purposes. They also call depreciation in tax, they call it cost recovery. So they're slowly recovering the cost that an asset that was incurred in order to attain an asset. Same kind of concept with regard to, depreciation. You are expensing that asset over the useful life of the asset, but with financial accounting, you get to choose what that useful life is, right? You get to decide, I think this table is going to last 10 years, or I think this table is going to last 5 years. You also get to decide that, well, I think at the end of that 5 or 10 years that this table is going to have a value of $100. It's going to have a salvage value, so an amount that we think it's going to be worth at the end. For tax purposes, you do not get to choose what the useful life is. The IRS just says, it's a table, it's got a 7-year life. That's it. Doesn't matter that there's anything special about that table. That may extend its life or make it shorter. It's a piece of furniture, and so therefore its useful life is going to be 7 years. Also, there is no salvage value for tax depreciation. So we don't have to figure in any anticipated salvage value for that. Also, the method that you use of depreciation for financial accounting purposes, you get some choice as to how you're going to depreciate. Are you going to use straight line for your table? Are you going to use some of the year's digits? I don't know if you guys, those of you have taken or are taking intermediate, if you've gotten to that point yet. I think that's a little bit later. You're gonna learn about some. I think you talk a little bit about it in Prin 1 or Prin 2, but you get a little bit more in depth with the different depreciation methods, popular depreciation methods that are used. You can also make up your own kind of depreciation method. You could also use, units of production. So if you have a rivet maker, you can depreciate it based on the number of rivets that it actually produces. So if it produces 10,000, you can give it a depreciation value for each of those rivets. And so, the more you use it, the more it's going to depreciate. In tax, you don't get to do that. Again, the IRS says what the useful life is going to be, and they tell you what the depreciation method is. Of course, there are exceptions because, as I've said, there are exceptions to every tax rule has some exceptions. So there are a few different things that you can do in tax to accelerate depreciation or accelerate write-off of assets. But for the most part, we are pretty limited to what we can do. And there are these 4 components of depreciation that we're going to go through, these 4 pieces of information that we have to have in order to determine how we're going to depreciate an item. So just like with financial accounting, we depreciate tangible property, we depreciate real estate, and we depreciate personal property, so that table. Personal property is different from personal use property, by the way. Personal property is just any property that is not real estate. But it's used in a business. Personal use property is your personal stuff, your personal car, your personal furniture, that kind of thing. So when I say personal property, what I'm talking about is anything that's not real estate. Just like with financial accounting, though, we don't depreciate land for tax purposes. Land does not get depreciated, but buildings do. And how we depreciate those buildings, you'll find out, depends upon what the use is for that building. So first thing we're going to do is go through these different components of depreciation. We're also going to learn about a different form in this section Form 4562, and this is probably all we're going to cover today is this learning objective 3 regarding depreciation, because it's a lot of information. I said it really should be its own chapter, but instead they just make it one section in this particular chapter. The method for depreciation, the most common method for depreciation for under tax is referred to as modified accelerated cost recovery system, otherwise known as MACRS. So that's another one of those acronyms that you're going to want to become familiar with. Modified accelerated cost recovery system. So again, cost recovery, depreciation, we call it cost recovery in tax. Accelerated, so it is a form of accelerated depreciation, meaning that we front load the depreciation. So you're going to get more depreciation expense and deduction in the early years of an asset, for the most part, with some certain exceptions, more depreciation expense in those early years, and then in the later years it will dwindle down. Modified, meaning there are certain modifications to that acceleration. It switches to a straight line depreciation at a certain point. Okay, so these 4 components that we need to talk about, we're going to talk about them each individually, are basis, known as the cost plus or minus certain adjustments. So with the J. So basis, we're going to talk about that. Usually this is what we paid for the asset, but that basis can adjust over time. Second one is our depreciation period. So we also call this the class life. So how long do we get to depreciate it over? And the word class should tell you that there are different classifications of assets that they're going to, depending upon the classification of the asset, will then determine what your depreciation period is. Like I said, furniture, I gave you that example of the table. Furniture is a class. Furniture and equipment is a class of assets, and it has a 7-year life. That just, it is what it is. That's the class life for it. The third one, and this is kind of the most foreign concept to most students, is called the convention. We're not talking about a meeting of people. The convention has to do with when an asset is placed in service. So for financial accounting, if we buy something and place it into service on July 1st, then we start depreciating it on July 1st. If we buy it on August 17th, we start depreciating it on August 17th. It's pretty simple, right? That's not how it works with tax. When you start depreciating an asset depends on which convention you have to use. So like I said, that's one of the kind of more foreign concepts of depreciation that most students kind of struggle a little bit with. And then we have the fourth one, depreciation method. So what method do you get to use? We have 3 methods. We have straight line. We have 150% declining balance. And we have 200% declining balance. Now, the nice thing about this is that the IRS gives us tables that we can use to do the calculation for the depending upon the type of method that we're using, depending upon the convention we have to use, our depreciation period. We can then take our basis and we can apply it to the table to determine what our depreciation is for a particular period. All right, so first thing we're going to talk about is basis. So again, it's similar to book value of an asset. Depreciable basis is usually what you pay for it, the cost to purchase it and to place it into service. So it would include things like your installation costs, your shipping costs, your sales tax, all of that stuff, same as for financial accounting. So all of the expenses that are associated with it. The basis, though, can differ depending on how you acquired it. The most common method of acquiring an asset is just purchasing it, right? You go out and you buy it. You might finance it, but you're still purchasing that asset. So if the property is just purchased, it's going to be whatever your purchase price is for it, whatever you paid for it. However, if the property is inherited, so it's entirely possible to inherit property and then put it into use for a business. Again, we're only talking about businesses here. Personal use property, so like your personal house, your personal vehicle, any of those personal items, your personal furniture, none of that is ever depreciated. These are only assets that are used in a business that we depreciate. But property could be inherited and then you put it into use into a business. Like, so for example, let's say your grandpa left you his home or his condo, and you decide that you're going to rent out that condo. You're not going to use it for yourself. You've already got a place to live. You're going to make it into a rental property. Well, now you've made it into a business, but you inherited that. If it's inherited, the basis is usually the fair market value on the date of the death of the person who died. So even if grandpa bought it in 1970, if he passed away today, what is today? October 2nd, 2025, whatever that fair market value is today, that's what the basis is going to be. And we're going to use that basis to determine what our depreciation is. Okay. And this is a good thing, because if it's an appreciated asset, something that's gone up in value, then that means that your depreciation deduction is going to be higher than if you had to use that price, what he paid for it in 1970. Now you're not going to get as big a tax write-off, but now you do, because you get to depreciate it. If the property was converted from personal use property to business use property, so that's where I take my personal car and I put it into my business. So let's say I've got a van, and I'm going to get myself a new van, but I'm not going to get rid of this old van. I'm going to now use it in my business. Maybe I have a bakery or something. I'm just going to transfer it into my business. So in that case, what I've done is I have converted it from personal use property to business use property. The basis is going to be the lower of the fair market value of the asset, whichever is lower here, or the cost at the date of the conversion. We'll go through some examples. I think we've got some examples hopefully down here. Yeah, we've got an example to kind of show you what that is. So we've got a choice between those two, either the fair market value or the cost of it at the date of conversion. Basis can also differ from the cost of the property if the property is acquired in a non-taxable exchange. This is not used all that much anymore. It can only be used for real estate. They would have these non-taxable exchanges that you could do so that you could defer recognizing a gain, which means you get to put off paying taxes on something when you dispose of it. You can only do that for real property now. Typically, the depreciable basis of an asset received after a trade-in is going to be the cost of the new asset, whatever you pay, whatever the cost of that new asset is, minus any deferred gain on the old asset. So if I had a building and if I were to sell it, I would get $100,000 gain on that building. I'd receive $100,000 gain that I'd have to pay tax on. But instead of selling it, I'm going to exchange it. I'm going to trade it in for another building. Now, instead of paying that tax on that $100 or $100,000 gain right now, I'm going to transfer $100,000 and to the new building, reducing the basis of that building. So ultimately, when I sell the next building, I'm going to have to recognize that gain at that point. So that's what they're talking about there. So depreciable basis of an asset received after a trade-in, the cost of the new asset less any deferred gain on the old asset. So here's kind of a list of how these are, the basis is determined. So if you purchase it, obviously it's the cost of the asset, whatever you paid for it. If it was converted from personal use to business, lower of fair market value, lower of cost or fair market value at the conversion date. So what cost being what you originally paid for it. Chances are, if it's an asset that's depreciated, then it's going to be the fair market value. If it's an asset that has appreciated, then it's going to be the cost. Okay. Non-taxable exchange, usually it's the asset's cost less the deferred gain on the old asset. So you have to do that calculation of what would the gain be on that old asset if I were to sell it, and then attach that amount to the new asset and you're attaching it by decreasing the basis. So it means you get to depreciate it. You get to depreciate less of it. So your depreciation expense is going to be lower. Plus, when you sell that next asset, you're going to have a larger gain at that point. And if it's inherited, then usually it's the fair market value of that asset at the date of death of the decedent. So let's look at an example. So Ashley bought a computer for $2,500 to use in her sole proprietorship. So she just bought it for the business. That means that her basis is $2,500. It's what she paid for it, right? Whatever she paid for it. She also inherited land and a building from her father. The land had a basis of $10,000, but remember, we don't depreciate land. We still have to put this land on our tax return as listed as an asset, but we're not going to depreciate it, right? It's just going to stay on the books, essentially, or the tax return at $10,000. Eventually, if we sell it for $20,000, then we're going to have a $10,000 gain on that land, but we're not going to depreciate that. Land has a basis of $10,000, fair market value of $18,000. So because she inherited it, though, she's going to get to put it on the books at $18,000, but we're still not going to depreciate it, right? At the date of death of her father, the building had a $150,000 adjusted basis and a $300,000 fair market value at his death. Well, now the building we can depreciate, and we get to use the $300,000 as the basis for our depreciation for the building. We're not going to depreciate the land, but we can depreciate the building part of that. She uses all of them in her business as an office. In this case, the computer has a $2,500 depreciable basis. The building's depreciable basis is $300,000 because it was inherited. We call that a stepped up basis. It's one of the benefits of inheriting property is you get to step up that basis. So essentially, the gain that Dad would have recognized if he had sold it just disappears. Nobody ever has to pay tax on it. And then the basis of the land would be $18,000, sorry, but it's not depreciable. Now, here's an example of that conversion. She also converted to business use an old van. Okay, so she had a van. She used it personally. She is going to now use it in the business. The basis of the van, so what she paid for it, her cost of the van was $13,000, but the fair market value right now is $6,000. That's on the date of conversion. She has to use the $6,000 as her basis for the van in her business, okay? Because it's the lower of the cost, what she originally bought it for, or the fair market value of it. That makes sense because a van is something that depreciates over time. It does not gain in value unless it's like an antique car or something like that, but then she wouldn't be using it in her business. So had the van been used less than 100% for business, and this is just kind of an aside that we'll talk about this concept a little bit later too. So if it's not used 100% for business, so she uses it partly for personal, maybe 25% is a personal van, 75% is business, then the basis is going to get adjusted based on the percentage that's used for business. So she'd get to depreciate her basis would be 75% of that $6,000. Does that make sense? So it's only the business use portion that's going to be depreciated. This is a good point to make. Used property. Well, and it was already depreciated by somebody else. So let's say that van, she didn't convert it from personal use. She bought a used van for $6,000, but it was fully depreciated by somebody else. So she bought it from another business who's already fully depreciated the van. Does she get to depreciate it again? The answer is yes. So she gets to depreciate whatever that cost is. So here, a taxpayer has an 8-year-old piece of equipment to use in a business for, they bought an 8-year-old piece of equipment to use in a business for $4,000. Can the taxpayer depreciate the $4,000 cost, even though the equipment was used and most likely was fully depreciated by the prior owner? That doesn't matter. The fact that they paid $4,000 for it then means that they can depreciate that $4,000 worth of cost. Okay, doesn't matter whether it's new or used. Does not have to be a new piece of equipment. It can be used. All right. So that's the rundown on basis, how we determine what our basis is. Questions? No? Okay.